Okay, let's talk about chapter 12. Chapter 13, 338 election. Don't expect me to ask you a complicated question on that because I'm not even going to try and teach it. What you need to understand is what my reasoning was for touching these subjects now again was so that when our person that uses this stuff out in the real world talks about it, has examples, and tries to get you to figure things out, that you'll have some framework. Thank you very much. You'll have some framework for that, where otherwise, every other class that's ever had this, at least for the other two times I taught it, they were basically cold. So, he came in and just started, and people had no idea what a taxable purchase acquisition would be, and a 368 reorg type would be. My students hadn't read it. Now, I had suggested that they read the materials before, but that's just not the same as forcing you to struggle through questions. Because I think that makes you attack the material a little bit. And so you actually gain some knowledge, I think, even if you don't want to. Okay, so again, I've never taught this course this way, and I've never used this textbook. The textbook has some strengths and weaknesses, but one of the strengths that it has is it has questions that at least focuses a little bit on some of the materials. The teacher's manual is telling me, well, here's some more complicated things that you can present, and I'm looking at it saying, like, it's hard to get the basics. So, but anyway, that's my struggle. But okay, so the other thing is, again, for those of you that just came in, there's not going to be a heavy-duty question on chapter 13, 338. But I do want you to know something about it, so we're going to talk about it. And then the taxable acquisition idea again. I'd like you to understand a little bit about that, but it's more likely that that question will be on the final. You understand what I'm getting at? Okay. So I haven't made up the exam yet. I'm going to be making it up this weekend as I finish up my 2 extended tax returns and this test. And my thinking is, and I may change my mind, my thinking is I'm going to give you some multiple choice questions that have to do with calculations. The types of things like the formation of corporations and basis, and those issues that we dealt with in those 2 chapters dealing with the corporate formation stuff. And I'm also going to give you some problems, and there may be some overlap. Again, I haven't decided how much, but I'd like some of it to be objective just so I can scan grade and see how everybody does pretty quickly. And then the problems I have to hand grade, and basically I grade each one. I grade number 1, number 2, number 3, and kind of get a feel for how the class is doing. And I don't know who you are when I'm doing it. And then when I put it together, I'm just as surprised as you are. Again, you're not going to be penalized by me in the sense that if you've done the work, you've done the homework and everything, and you do halfway decent on the test, even after I curved it, you've done halfway decent, then you're going to get an A or a B here. This is not a class like Tax 5015 where you can get a C, D, or an F. It's not approached that way. I really want you to enjoy the course in the sense of, maybe, in fact, I'll tell you right now, if I was out there working, I already have gotten a million ideas in this whole area, whereas before I had no clue and wasn't even interested in it. And by struggling with this and playing with it, and then when Paul comes in, really shows you how to use some of the tools, I think that you'll have a good feel for it. So, I'm always thinking about what kind of a product am I putting out there. Somebody hires you. Yeah, you're not gonna be a tax expert, but we don't have an LLM in tax. I took 32 hours of 2-hour courses in tax. You understand? I mean, that's just a lot of tax. And we don't have that here. We've never been able to do that. But, you know, if you're exposed to issues, issue perception, and so I'm gonna try and design some questions, you know, that you might recognize some of the issues that we've seen. You may not know the answer, but I'm just trying to get you to recognize the issue. On the other ones, the stuff that we banged through at the beginning, you know, I think we've got those numbers pretty well down, you know, handling that and the liabilities and, you know, those sorts of things with formation. So I think that's fairly straightforward. There are a few issues that we talked about even in doing that, you know, that I'd like you to recognize the issue. You don't always have to know the answer, but I'm looking for issue perception. So anyway, we'll see. But my anticipation is it's probably going to be half multiple choice and half problem essay / type of situation.
And the bulk of it's going to be chapters 3, 4, 5, and 6. Because 15, 12, 13 are all like rewords.
And okay, doesn't even say it's going to be on the test?
It just says like all material covered, but I know that you had said like with chapter 13 there won't be.
Yeah, I'm not going to hit you with this real heavy duty 338 question. I mean, I'm going to hit you with the one on the final, but I mean, I'm kind of worried about it. And we'll talk about it a little bit more.
And I didn't know if we were doing the reorgs before he came or after he came.
No, the reorg stuff would be more definitional type situations. You know, stock for stock, which one is the one that allows you to get just 38 to 40% stock? You know, those kinds of things that we talked about pretty extensively, where we answered the questions in the back of the chapter, I think, well enough to be able to handle those. I don't anticipate just yet saying, okay, here's the tax situation now, which tax, and assuming you want a non-taxable reorg, which one would be the best? I'm not there yet. You know, I don't feel like we've struggled with that enough to do that. I'm more at the definitional aspect and some of the things that they expose us to. So, I'm hoping maybe some of that will be in the final. And of course, the other thing I'm thinking about, because I'm always thinking about how we change it, and I thought about, you know, giving y'all a project instead of a final, but I don't think that's in the cards. There's not enough time, and I don't know this area well enough to come up with good projects. So we'll probably go with the exam. The exam maybe have more objective questions on it. Again, I don't know if I can find objective questions on that, so I may be stuck with an essay type test, such as one. But again, I'll treat you fair, and again, I hope you've been exposed, like in an inoculation, to a lot of things, so that maybe you'd say, well, wait a minute, isn't there an issue here about this? I don't know the answer, but isn't this something we need to worry about? And the answer to that might be yes. And then you go research it. And if you don't miss an issue, that's the key. Do you mind talking a little bit about your situation, very much in general, kind of what you're going through, just the issues and stuff? And because this class helped you come up with some ideas anyway.
The partner and I have a company under contract, first close of the month. And originally it was an asset, it's an escort. Originally we structured the price as an asset purchase. So the seller would get liabilities and, you know, which
buyers normally like to buy assets because you don't get the liabilities. Assuming, tell them about the assets, assuming the assets you transfer.
So, yeah, and so the problem is that this company has something like 1,000 contracts, not all of which were transferable to, you know, automatically to another buyer. So we threw out, you know, I throw out the option of a stock purchase with a Section 338 exchange and for election. And so that's where we're up to that. Of course, now I'm also pushing for a change in price because of that, because now I don't, you know, I'm never going to know where the liabilities are fully or due diligence. So, but yes.
And that's an issue. And one time I represented a client in a taxable transaction, and I think I mentioned it before, but I did sort of a, Pricewaterhouse used to have something called a business person's review or something. Of course, back then they called it businessman's review, but they expanded it to the first. But I didn't really even do that. But I said, look, I've done a little bit of work here, and I'm not pretending to even be the CPA on this, but I'm just telling you, something doesn't feel right with this. And I said, I don't have time to do any more. I'm just telling you, something's really bothering me. And I said, look, as a professional, maybe I shouldn't say anything, but I've learned that if my instincts are bothering me, I'm going to tell the client. And you either do more work to get the answer or understand you're taking a risk. And my client says, no, I'm going to buy it. I mean, he was going to pay all cash. It was like a couple of $1 million. He's pretty well off. And I said, well, then let's put in there a deal where if things aren't what they say, we'll have a promissory note, so they won't get all cash now. They have a promissory note, and I wrote an offset provision in there, which is that if these things come up, then we don't have to make this payment. And it's about $500,000. Saved them $500,000. Still was a lousy deal, but at least that idea, and then you're thinking about that too. And so he's buying an S corp, and when you originally S corp, geez, you don't even know if it really is an S corp. I mean, that's a terrible issue.
Yeah, the note I did not fly with the seller.
Pardon me?
The note I did not fly with the seller well, also now I have to worry if he.
Yeah, I mean, they're going to be upset because now, but you're actually buying the corporation, which is normally good for a seller, but you're going to have some other consideration for that because of the liabilities. And like I said, the offset against the note is one good way. You just got the language has to be really good about what mine was pretty much in my client's favor. And so we didn't have to argue about that $500,000. We just didn't have to pay it. Yeah, so anyway, but it's interesting. But again, so that's an exposure. You wouldn't think you'd really use this stuff, and sometimes you do. Okay, so let's take a look at Chapter 12, General Rules for Taxable Acquisition. And it tells you in the first paragraph, I'm on page 219, that the basic decision is to buy stock or buy assets. There's a lot of factors that go in there, but primarily the potential liabilities are the big issue. If you buy the corporation, you bought the whole package, including all the potential liabilities that corporation may have. If you buy the assets, you usually don't get the liabilities. Now, there's exceptions to that rule. If you buy land or property, the Superfund cleanup stuff, applies to even a new buyer. So there are, you can get liabilities even when you buy assets, or what I'm saying, but not usually not as often. Versus like the situation Bill was talking about, where there's assets that the corporation has that can't be sold or transferred or assigned. So only the corporation has them, and if you want those contracts that badly, you're going to have to buy the corporation. So those are some of the issues that you get into stock versus assets. And then also, when you buy assets, you have to do title transfers. And lawyers make a lot of money because that takes a lot of time. And then there's taxes when you transfer. For example, if you bought somebody's dump truck business and you bought their 1,000 dump trucks, you got to transfer the titles to 1,000 dump trucks. If you buy a bunch of land from them with buildings on it and stuff, you have 10 land transactions. And the state of Florida is going to get a piece of that. All sorts of things like that. So when the entity changes that owns the property, you've got to go through that. So those are some other things that you think about. The second paragraph, in general, if the stock is acquired, there's just going to be one gain or loss. Because the shareholders are treated as selling their stock, they take their basis versus what they receive. Inside the corporation, there's not going to be any tax effect to the corporation generally. Now, then there's an exception. If you do a 338 election, and there's several different 338 elections, where the transaction is treated as a purchase of assets, even though it was in the form of stock. Chapter 13 talks about that. But there's other issues you have to get over, like, you know, if you buy the corporation, do you get the loss carryover? Well, those are limited because they don't want people to buy corporations just to pick up the loss benefits. And so there's restrictions on what you can do. Again, beyond the scope of what we're doing here, but just the idea that there are restrictions on it. You know, anytime, anybody in here read the Wall Street Journal? Just one person? Okay, 3 or 4, okay. If you're reading about a really cool tax technique, then consider it gone. If it's in the Wall Street Journal, then the IRS, the Treasury, everybody reads that, and they show it to the senators and the people in the House. Look at this. This is a loophole. It's not fair. Blah 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 blah. And if there's no push to save it, the loophole disappears. And I did estate planning for 30 years, and there's a whole bunch of things that we did that worked that I never told anybody. I didn't have to brag. I didn't have to write an article about it. Because once you write an article about it, everybody knows about it, and then they can figure how to attack it. If they don't know about it, you know, it's a done deal. Time passes, it's over. So sometimes trying to brag and show how smart you are actually is not to the benefit of your clients. So okay, so you can treat a stock purchase as an asset purchase. There's a deemed sale, and then the next paragraph talks about why would you want to do an asset purchase? Well, sometimes you don't want all the assets. Besides the potential liabilities, you don't want all the assets. And so when you buy all the assets, it's separate purchases, and then you come to allocation of the purchase price. And I used to do this early in my career. I did a lot of this, and we would try to agree in the contract to the allocation of the purchase price. And it was before Section 197 came in, and you agreed to it, and as long as it wasn't fraudulent, you had a shot at it working. Both parties reported it the same way. But sometimes one party didn't care, tax-wise, and the other party did, so the IRS would come and say, I know you agreed to it, but so what? So there was always those issues. But you were certainly better off doing that than making no allocation, and then when you file the tax return, suddenly you make an allocation, and the other party's not a party to it. So that's what you're dealing with there. Okay, on page 220, taxable asset acquisitions, and section 1060, and let's just look at a couple of code sections because I know I make you curious, and I carried mine and I didn't have my roller bag, and nearly killed me. But anyway, I brought it, at least one of them. Okay, so code section 10601060. So my page 562, but I'm at 549 on the brand new spanking copy. Okay, 1060. Special allocation rules for certain asset acquisitions. In the case of applicable asset acquisition, to determine the transferee's basis, that's the purchasers, and the gain or loss of the transfer, or it's got to be allocated among such assets acquired in such acquisition in the same manner as amounts are allocated to assets under section 338B5. We're going to look at 338 in a second. 338B5. If in connection with an asset acquisition, the transferee and the transferor agree in writing as to allocation of the consideration or as to the fair market value of the asset, such agreement shall be binding on both unless the secretary determines that the allocation of fair market values aren't right, aren't appropriate. Okay, so, but notice that's going to throw you under the regulations under 338 too, the regulations. Okay, so, and let's see. so let's look at 338 for a second. Okay. 306 in the new book. Section 338, certain stock purchases treated as asset acquisitions. I mean, that's a fairly clearly descriptive title, wouldn't you say? And then 338A, the general rule, if a purchasing corporation makes an election under this section or is treated under E as having made such election, then in the case of a qualified stock purchase, the target corporation shall be treated as having sold all its assets at the close of the acquisition date at fair market value in a single transaction, and shall be treated as a new corporation which bought all those assets referred to in one there at the beginning of the day after the acquisition date. And they talk about the deed purchase price in 338 little b. And what was it, B5? Yeah, so the allocation paragraph is down there toward the bottom of the page, at least on mine. 338 little b has 1 in general, 2 adjustment for liabilities, 3 election to step up the basis of the target stock, 4 grossed up basis, and finally 5 allocation among assets. The amounts determined under paragraphs 1 and 2 shall be allocated among the assets of the target under the regulations prescribed by this architect. So these are what they call legislative regulations. In other words, the Internal Revenue Code section specifically says that the Treasury can make them up. So Congress is delegating basically lawmaking, to the Treasury in those regs, and unless they're absolutely against the whole intent of the statute, they're going to be upheld. And if they've been around for a few years, they're going to be upheld. If no one's been successful knocking them out. So if you're going to go against those, if I had a client and say, well, that's a big uphill battle, but they just put them out 2 months ago, and there's some holes in them, and maybe we can knock them out now. That's your best shot. If they've been around for 5, 6, 7 years, haven't been knocked out, and people have attacked them, forget it. It's the law. Okay, so, and 338H10. So 338H, definitions and special rules, and number 10, they're in parentheses, H1 through 10. Elective recognition of gain and loss by target corporation together with non-recognition of gain and loss on stock sold by selling consolidated group. That's already gone beyond my vocabulary. So, but it's a different election than the plain old 338 election. It's actually two. Okay. So let's go back to the textbooks. At least we did glance at the code. And can you see here where if you're involved in representing a client that was buying or selling assets, that you could get excited about this? Because you may be able to save them a bunch of money, you may be able to help them negotiate. Because it's a negotiation process. Buyers want to buy assets and sellers want to sell stock. That's where you start. Okay, on page 220, it talks about, in that first paragraph, 1060 that we just looked at, and the regulations under 338. Now we know why they're under 338, because 1060 basically says those regs. And the regs, 1.16 is about 6 lines down. -1B2 provides 2 alternative tests for existence of a trade or business. And this is getting into some stuff we haven't dealt with, the tax-free spin-offs, or the more inclusive test of whether goodwill or other going concern value could, under any circumstances, attach to that assets. It defines goodwill. And the next paragraph says, 1068 says if the buyer and the seller can agree, it's binding on them, but of course it's not binding on the Internal Revenue Service. Yeah, okay, well, yeah, anyway, okay. Under the regulation, the taxpayer may argue against the agreed allocation on elements from a mistake, undue influence, or fraud, which I think I could have shown in my case with my clients. But anyway. And then even without the agreement, both the buyer and the seller are obligated to report their own allocation of the purchase price to the service in their tax return. Okay, so what's at stake? Well, first off, a lot of times the assets inside a corporation have a low basis versus their fair market value. So if you buy the corporation, you're stuck with that asset, which is pretty much fully depreciated, right? 7 years, a lot of assets fully depreciated. But the fair market value of those assets, you can't get them anymore. They're not made anymore, you know, and they're still productive, really. So you'd like to get, as a buyer, you'd like to get a step up in basis. Why? So you can depreciate them again. And so that's what you're trying to do there. So the seller side, if you're allocating directly against assets themselves, you know, what are they trying to do? Well, they'd like to reduce the gain. And if they do have a gain, they'd like it to be in Section 1231 property or capital asset property, those sorts of things. Remember, and of course, the seller doesn't want it to be attributed to Section 1245 property that's fully depreciated, because then all their income is ordinary income. So if we're talking about a human being, that's not good, right? Capital gain versus ordinary income. So you're dealing with that. It reminds you in this paragraph on 220, so it talks about 1245, which we all know is the ordinary, to the extent of all depreciation, the gains are captured as ordinary, and that applies to all taxpayers. But look at the very last sentence in that paragraph, bottom of the page. Remember, so what as far as a corporation? The corporation's capital gain, if all they have are capital gains, long-term capital gains, they're taxed at the ordinary income rate for corporations. But most of the time, it doesn't make a difference. But back in, so 1245 would make it ordinary, which certainly would affect an individual taxpayer heavily. 1250, remember, is the one, it's not considered recapture. They didn't define it as recapture, but basically, you know, all the depreciation taken on after 1986, 1187 forward on real estate, all the depreciation is Section 1250 unrecaptured, because after 1231.86, Section 1250 didn't apply to any real estate anymore, because you had to take real estate on a straight line basis only. In the old days, if you took it on a straight line basis, there wasn't any recapture. Just, you know, if you took it accelerated, just the excess was recaptured. So straight line used to be a safe harbor. So once they passed that law, starting in 1187, if you had real estate, you had to use straight line, and therefore none of it was recaptured under Section 1250. So they thought about that for a few years, and then they went, you know what, we're missing the boat here. So they passed a thing called unrecaptured Section 1250. Again, because all Section 1250 is unrecaptured by definition after 1187. Okay? And so what they said was, to the extent of all the depreciation you took, which is the same language as Section 1245, that, if you have a gain for that much, the tax rate on that is 25%. Whereas at the time they passed it, the maximum tax rate on capital gains was 15. In 1231 property, you know, you've got long-term capital gain treatment of 15%. And now it's about 20%. Okay, so it's 25. It's really another recapture provision, but it's not called recapture. Sometimes that's important, it's not. Anyway, so that's 1245. 1250 only applies to human beings. The 1250 unrecaptured has significance to that. And then there's the one other corporate rule, which is, about 10 lines or 11 lines from the bottom. Nevertheless, corporate sellers are subject to a special rule under 291. And 291 basically recaptures 20% of the difference between the 1245 and 1250 number. And again, the 1250 number is 0. So let's pretend it's all 1245. That is ordinary income. But most of the time, what bugs me is that that's asked on the CPA exam. Sometimes they want you to calculate it. And yet, most of the time, and I have a handout in another class, I say, so what? Most of the time, it doesn't matter that it's ordinary income. The only time it matters is if you could end up with a capital gain that could offset a capital loss that you had before that you couldn't use as a corporation, then it makes a difference. It takes it away from you being able to use. That was the gain becomes something else, so it's not long-term capital gain. It's not 1231 gain. So you can't offset a capital loss at the corporate level. That's the only significant. Well, the CPA time, they still talk about it, and it's talked about in all the books like it's a big deal. And to most of my clients, I say, look, technically, there's this 20% recapture, but the bottom line is it's not going to affect most people because you're paying ordinary income rates already at a corporate level most of the time. It's just if you had capital losses to offset, then it would make a difference because that part would not be allowed to offset a capital loss. See, because it's an ordinary. Okay, so that's what they talk about. It says, nevertheless, corporation is subject to a special rule under 291, recaptures a portion of the amount that would have been recaptured if 1245 applied instead of 1250. In other words, if 1250 applies, there's no recapture. That's why it's called unrecaptured 1250. But if you pretend it's 1245, it would all be recaptured. Then 20% times that number is the amount that you recaptured for corporations. It says, furthermore, some business property gains and losses will be included in the taxpayer favorable 1231 calculation. Overall gain will be 1231 gets long-term capital gain, but a net 1231 loss would be an ordinary loss. 1231 is the best of everything, and it works for both corporate and corporations. So that's so if you have a 1231 loss, the corporation can take that loss against normal operating income. So that's a big deal. So in the loss area, it's a big deal for a corporation. Okay. All right, buyer's side. What are the consequences on the buyer's side? Buyers are interested in allocating purchase price to those assets that will give you the most rapid and most basis recovery. Therefore, they want to shove it toward tangible personal property, which you can depreciate relatively quickly, 3 to 7 years, and most of it's going to be 3 to 10 years. Most of it's going to be like 7. As little as possible to land, because land's not depreciable, right? Unimproved land. Okay, so, and then, we had the issue where you'd allocate a bunch of stuff to a client list. And then you say, well, we allocated this amount of the purchase price to the client list. And, 3 years from now, that client list is worthless. So you'd write it off over 3 years. And the IRS would, no, and they'd litigate, and the IRS would lose. They lost almost every one of those cases. So then they went, obviously I'm a taxpayer, pro-taxpayer. The IRS went crying to Congress, oh, look, and so got Congress to change it and come up with Section 197, which says, look, let's make it, right now you can't write off goodwill. Let's give this to the taxpayer, and they can write off goodwill. Yippee, over 15 years. It's actually 180 months, but 15 years for roughly, okay? And before that, you couldn't write it off. They argued you couldn't write it off at all. But, remember the old GAAP rule? It didn't have a useful life. You couldn't write it off. They're kind of back to that now, but whatever. For GAAP. But anyway, so they lumped that in. Goodwill is a Section 197 asset, as are a bunch of others. Here's the big deal. Covenant not to compete is a Section 197 asset. And I'll tell you, I haven't seen a 15-year covenant not to compete ever. It probably wouldn't work. Yeah. Now, I think there was a 10-year one that was upheld, but it was like the sale of a national CPA firm. And it was for the whole United States, something like that. But other than that, I would tell you, if you're taking the CPA exam, that's not the one I want you to remember. I want you to remember that generally 5 years work. Okay, so most of your covenant not to compete are going to be 5 years.
Well, here they are.
Say what?
You get it from like we're buying this company, so we can get it 5 years from our owner. Yeah, like Florida law, in terms of employees, only two to 3 will work.
Yeah, and see, I'm not that familiar with that anymore, but 5 years for the seller makes sense to me. But it has to be reasonable as to time, and 5 years has been upheld, okay, you know, with owners, I guess, and geographical location. So if I buy your pizza store and, you know, pizza shop in downtown Tampa, that probably wouldn't hold up, but somewhere in Tampa, and the covenant not to compete is 5 years. 5 years will hold up, I think. You buy it from the owner. But I say, and the state of Florida, unless, you know, and it's the only pizza shop. You know, any judge is going to say that's unreasonable and throw it out. Now, the thing is, and I don't know what the Florida law is on this, because different states are different. Some states say, okay, because that was too broad, the whole thing is out. But some states say it's too broad, so we'll enforce it for Hillsborough, Pinellas, and Pasco, because that's reasonable. I don't know which direction Florida goes. There's an answer, but I just don't know that. You need to know that, because especially if you have one that might be broad, and I'm writing as a lawyer, I want to know. I tell my client, look, you know, this is too broad. It's going to get thrown out, and if it gets thrown out, the current law is you lose the whole deal. You know, if that's what it was in Florida, I don't know. Okay, so that's an issue. But the point is, it's a 5-year. You have to write that October 15th. It's a 197 asset. The covenant not to compete is a section 197 asset, just like goodwill.
Like if you have it, it's very specific, like.
I don't know. Because patents, a lot of times you get them, they've only got 9 years left. So I don't know. You know, you can find out by researching. I think it's on the list, but I'm not sure. I think it's on the list, but okay. So they talk about this on 221 until the adoption of 197. You know, we didn't want to allocate anything to goodwill because you couldn't write it off, and we'd allocate stuff to customer lists because you could come up with a useful life for them and write them off. 197 now allows the amortization of most intangibles over a 15-year life. Folks, if somebody wants to get on the internet, you could look up that patent. You could find it pretty easily on that with a covenant nothing. And if it's a section 197 asset. Okay, so next paragraph, an asset purchase will ordinarily leave the tax attributes of the selling corporation, like losses, earnings, and profits, and other special accounting methods with the selling corporation. So you aren't buying those. When you buy the assets, you can't buy the corporation's loss carryover. Now, the 338 election, most of the time, is not one that you're going to make because the cost to the selling corporation of recognizing all that income is going to affect the purchase price in such a way that it may not be an equal trade-off for the higher basis you have to write off the assets. You see what I'm saying? It may not be a good trade-off. Most of the time it isn't. So what you have to have is you have to have a selling corporation that you know, you're buying where you have lost carryovers. So when it's a let's pretend sale, which 338 is, that those losses can be used against the gains, and maybe there aren't hardly any gains to report. Now everybody's happy because the buyer got to step up in basis on the assets, and the selling corporation didn't have to recognize any gain. You see, because they had a lost carryover they could use, you know, or some other tax attributes that they could use. The other thing is, what if you had a corporation that had really high earnings and profits? Well, if you buy the corporation, you're stuck with that, which means what? Distribution's probably going to be dividends. Now, if your buyer's a corporation, you know, it differs, remember, because dividends are liked by corporate purchasers. You know, they like dividends because you get the dividends received deduction if you're a corporation. So that depends. But normal people don't really want that, human beings. Okay, so the allocation process on 221, and these things that we're talking about now, this might be this is the kind of stuff I might ask you about this chapter, okay, which is a little more fundamental, you know, not too racy yet. Okay, so it says, the regulations under 1060 and 338B5 direct that the residual method described in the regs, section 1.338-6 for initial allocations and -7 for redeterminations. I'm not going to be giving you a redetermination question, I'll say that. Must follow in allocating the purchase price among the assets. And you go first level, allocate up to a maximum fair market value. You allocate, then you go to the next level, etc. And what's at the very end is going to be purchased goodwill, which you can write off over 15 years. Okay, so next paragraph on 221, section 1060 and section 338 regs also dictate a priority according to which the purchase price should be allocated to various classes of assets. In the event there's a shortfall, etc., when when the purchase price is insufficient to provide aggregate basis equal to the aggregate fair market value of all, the shortfall will result in the buyer being obligated to make certain contingent payments. Those are some reasons why you might have a shortfall. So here's your regulation stuff on 222. This first complete paragraph. In general, the ranking reflects the likelihood that the purchaser will get a transaction in which lack of basis assigned result in artificial income to the purchaser. Under these rules, the purchase price and basis for the purchaser are allocated under Reg 1.338-6B. So 1060 throws you into those regs. We just want to write them once, I guess. And so first there's 7 classes. First goes to cash and deposit accounts. The second one to actively trade interest in personal property like stocks and bonds. Class 3 accounts receivable. 4 inventory. 5 equipment, land, and buildings. See how far down that is? 6 intangibles other than going concern and goodwill. So what might be a 6 intangible? I'm guessing covenant not to compete. Going to fall there. And if there's still purchase price left over, it's going to go to going concern value and goodwill. So they give us a couple of examples, and again, they always use small numbers, which is dull. So you add 3 more zeros, and make it 12,500,000. In your mind, because I think they pull them out of the regs and they don't bother to change them. I would kick them off a little bit. But anyway, okay. For example, 12,500. That's the partial legal fee and a little bit of the accounting fee. You know what I mean? If it's 12,500, you got to be kidding. Okay. But anyway, okay. So CDs first, inventory second, the 3 equipment 4, and customer list 1,000, and then what's left over? Well, that adds up to 489, and you're paying 12,500, so 3,500 is going to go to what? Goodwill. And again, make it 3,500,000. It makes it a lot more interesting. You feel like you can bill, for that. So that one, there was excess fair market value. It goes to goodwill. So the 6 and 7, the customer list is going to have to be written off. How long? I think it's a 197 asset, 15 years. Again, it's really 180 months, but 15 years. And the goodwill, same thing, 15 years. And then they drop the number down. What if the consideration paid had only been 8,500, or in our mind 8,500,000? Then you've got when you add up 3, 4, there's the whole thing. It looks like there's no goodwill. Here's my question: what if you had a covenant not to compete? You'd allocated $500, $500,000 to that. Where does that go? I don't know. I don't know. Installment sales make it pretty complicated, but there's just a few issues there that I wouldn't want you to miss on installment sale. So section 453 allows the sale of assets to be taken into account when the seller receives payment rather than when the assets are transferred. And not everybody qualifies for installment sale treatment. There's all sorts of rules about that, but let's say you did. But there are issues. You need to be careful about the notes. So look about 6 lines down. Sales for notes that are payable on demand or readily tradable are not eligible for installment sale treatment. And gain will be triggered to the extent the buyer's debt is sold or pledged. You know, so you can wait and collect and you're okay, but if you go get a loan and you pledge the installment note, if you pledge it, it's like you sold it. And a disposition of an installment, and that's the terminology, I don't know if you've heard it anywhere in any class, but you know, the disposition of an installment obligation, you better follow up on that. You better, you know, when your client wants to do anything, you need to tell them, you've got this note, don't do anything with this note, don't borrow money on it, you know, don't let it be collateral for anything. Talk to us first because it's probably going to be a disposition of installment obligation. You have to recognize all your deferred income even though you haven't gotten any money. Because when you put it up for collateral, you're treated like you did get money. You pledge it, that's the same thing, putting it up for collateral. So that's that. So let me see. Yeah, the second paragraph there, look at the last 4 lines. Starts with, moreover, to the extent the seller is required to recognize depreciation recapture under 1245 or 1250, that gain would be recognized. So, if you have an installment sale and you did everything right, but you have, let's say your gain's $400,000, you haven't received a penny yet, but you have $100,000 of Section 1245 recapture. The law says it's like you got that money when you sold the property. So that's a situation where if you don't advise the client, you say, look, hey, you're not getting any money now, what's going on here? You do realize, don't you, that to the extent of that $100,000 1245 recapture, it's going to be reported this year. So that's another mistake that people make. So if the tax person gets involved, you say, look, you got to understand, you've got Section 1245 recapture here, and therefore you need to get enough money to pay the tax on $100,000 at a minimum, or you're going to have to go borrow the money for that because you don't have any money from the installment sale. There was one other. And this is where look at it says recapture under sections 1245 or 1250, and this is something I don't know the answer to. It's just an issue. Technically, section 1250, there is no recapture under section 1250 because of the change in the law, and they call that unrecaptured section 1250. I want to be sure that it's not, I mean, I'm reading that and we're just reading somebody's comment. I want to be sure that unrecaptured section 1250 doesn't get involved with this. You understand what I'm getting at? We know 1245 will cause the problem, but and 1250, but you don't have any more 1250. But what about the unrecaptured thing? See, technically it's not a recapture, even though in my opinion it's a recapture of unrecaptured at 25%. But the terminology, and this is why I said the terminology there, that's something I would have to look at. I would have to research that. I mean, if you know that recapture clearly gets picked up in the year that you sell the property, to the extent you had a gain of 445 recapture, all of that comes in. You don't have any 1250, but what if you have unrecaptured section 1250? Does that come into? I don't think it does, but that's just a guess. I wouldn't stake my malpractice premium on that at all. I mean, that's you have to look at. Okay, so those are some of the issues that and then the third paragraph is when my eyes glazed over and I began to see if I could just find something to watch on TV. Furthermore, the benefit of the installment sale may be severely limited by section 453 big A, which imposes interest on the deferred tax liability. So as soon as I see deferred tax liability, I kind of slump out, you know. I ducked that the whole time I was on the audit staff. I've had to figure it out now as a tax person, but anyway, we know about deferred taxes, the tax provision, and all that stuff. At least we've heard about it. Okay, so that's enough of that. 224. I'm not sure how much of this, but let's just look at it. Paragraph 12.4.1.4 on page 224, top of the page there. The effect of later payments on basis and the amount realized. Again, not something I'd get into, but additional payments were made to the seller or for the seller that weren't included in the original purchase price. You know, what's that going to do? It may give you an increased basis, and then you have to go through a reallocation process again beyond the scope of what we're trying to do here, but just be aware of that. And look at the next paragraph. Suppose in the example in 12.1.3 above that a final tort judgment of $5,000 was paid in the 10th year after the purchase. You know, how would you handle that? Well, you picked up, you had $5,000. You'd already picked up only 500 of it when you did the original allocation. There's 4,500 that you didn't have before, and I think what they're saying here is you'd write out that 4,500. You put it in goodwill, and whatever is left of the 100, you know, how many years are left? This was 10 years later, so 5 years are left. You'd write that amount. You just found that about off over the remaining 5 years. You know, so there's some authority for that. Okay, that's all I really want to do with that. Taxable stock acquisitions is when you're buying stock. Remember, sellers want to sell stock. Buyers generally do not want to buy stock because of the liability potential. You know, remember, if you're trying to do a tax-free reorg, it's different. In that sense, it may work out. Look at what they're saying here, that first paragraph under taxable stock acquisitions, the last sentence. In general, however, any acquisition in which shareholders of target in the aggregate receive more than 60% of the consideration for their stock as cash is going to be taxable. Now think about what we've already talked about. What are they getting at? Do you remember that mergers and acquisitions, 38 to 40%, you know, the case, and so when they're talking, they usually use, that's what they're talking about. That's that 40%. Remember, you can qualify for a tax-free reorg under mergers and acquisitions if at least 40%, it was 38% was the actual case, you know, say approximately 40%. That's what they're getting at. Now see, if I was writing this, I'd give a little more there to kind of talk about that to refresh whoever's reading it. You know, the only reason I know is we spent time on it last week. You know, so we kind of banged on it a little bit. But anyway, that's what they're talking about. The section 368, you know, A1, minimum 40% rule has to be, at least 40% has to be for stock. And again, remember, there was a case that said 38% for stock was enough. Remember? You know, that's what they're getting at there. Okay, next paragraph, acquisitions for stock for cash or other consideration other than stock. And the stock of the acquiring corporation produced gain to or loss to the shareholders because they're selling stock, except as outlined below regarding potential disallowance of certain loss and credit carryovers when there's a change in control or unless a 338 election is made. The acquisition normally will have no tax effect on targets. So, you know, you're buying the stock, so you get the base, you get the accounting method. You may not get all of the attributes, the loss and credit carryovers. You may not get all of those. That's what they're warning you about. We're not going to dig into that, but you just need to be aware of that. There are restrictions on it. The buyer's consideration will become its basis in the target stock. That's the problem, because you're stuck with what you paid for the stock and you didn't pick up any basis to depreciate. So that's the issue. Last sentence, a step-up in basis is only available after recognition of the built-in gain, with which target holds its assets, a price that frequently netted the buyer and the seller willing to pay. Again, the 338, page 10 election, that's what they're talking about, I think. Okay, then they get into, and I don't want to get into the next paragraph about, if it's one or two transactions, because the IRS, the code section, I think, can handle that pretty much. They're going to look through that and treat it as one transaction. And then the redemption stuff, bottom of page 225. There's no accounting made in the treatment of selling shareholder for the amounts that would have been dividends had the target distributed its earnings and profits before the sale. It's fairly well established that if a corporation makes a distribution in redemption of the stock in connection with the sale of its assets, the shareholder will enjoy capital gain treatment if all the stock was sold without regard to the 302. So that would be a redemption that would count as a sale if it happens just before the transaction. That's okay. I think that's that bootstrap language that's in the textbook. That's useful if you can pull out some of the earnings and profits at a dividend, because maybe the buyer doesn't want to buy a corporation that has huge earnings and profits. 12.2.1, sales of stock in qualified small businesses. This is section 1202. When it first came out, I tried to use it, but you got to hang on to the stock for like 5 years or something. It has to be original issue stock, but you can exclude 50% of the gain. You can exclude 50% of the gain. The corporation can't be larger than 50 million, has to be an active business that uses 80% of its assets. The seller must be the original owner of the stock. So it's stock you bought originally. It's like 1244, it's got to be original issue stock, that sort of. And there's certain types of corporations that are not eligible. So medicine, law, athletics, farming, hotels, restaurants are specifically excluded. So 1202. The next one is dealing with those tax attributes when the control has changed. You have new owners of the corporation. 382 and 383 generally provide whenever more than 50% of the stock of the corporation is transferred within a year, and we have new stockholders, certain tax attributes will be reduced. Most important, 382 limits the use of losses of the target. In each year after a qualifying ownership change, you can only take a certain percentage. Okay, again, I'm not trying to get specific on that. That's just general stuff. Next paragraph, why do they have that? Because they don't want you to be able to buy tax losses. To get the losses. Okay, don't really care about the rest of that chapter. I'm not going to spend a lot of time on this 338 chapter, so just the beginning, and then we're going to work with questions. So this is chapter 13, section 338, and stock acquisitions treated as assets, acquisitions, and purchase of controlling stock with a 338A election. Corporate purchaser buys the stock, they have control, and controls is defined very strictly and a little bit differently than other sections, but basically 80% of everything, including the value. You buy a taxable transaction within a single 12-month period. You can elect to treat it as if the assets have been acquired. You must have the control. The election results in increase to fair market value on the basis of the target corporation's assets, allowing asset basis credit for consideration used by the purchaser when you buy the stock. The step up in basis comes at a great price. The deemed sale of assets requires the recognition of gain or loss with respect to all of the corporation's assets when they were all sold. And so what they're saying is, this isn't, the numbers on this aren't going to work a lot. That's what they're saying. It says it's hard to believe that you get a greater tax benefit by doing this because the cost of the liquidation, the deemed liquidation, is so high. So what if you get a step up in basis? You got to write that up over a number of years, and it doesn't work. It says in rare cases, a 338A election would make sense. The target has large expiring net operating losses that can't be otherwise used. They have large unrecognized losses that will be triggered. So they have a bunch of built-in losses, or it's a foreign corporation not subject to U.S. tax at all. So otherwise, the cost of the future tax benefit is not going to offset. It's just not going to be worth it. Then they say, well, why do we have this code section if you're hardly ever going to use it? Well, first we have to torture students. Okay. It used to work. General utilities, which made double taxation and corporate liquidations. Before that, it used to work. That's one of the reasons. The second reason is in the middle of page 230 of the first complete paragraph. That one I don't really understand that much. It says the original 338 replaced 334B2, which codified the Kimball Diamond Milling Company versus Commissioner, a 1951 case. In that case, the corporation was deemed to have purchased the assets, not the stock, if the target corporation was liquidated immediately after the purchase. And they just go through some different things, which I guess is exciting for them. If this was an estate planning case, I'd get excited about this paragraph. If this was estate planning, but I'm not. Okay, so anyway, they're just trying to give you some rationale. But the third one's probably the most interesting. The second to last paragraph. Third, although the election under 338 is rarely attractive, a related election under 338H10 remains very attractive when the target stock is sold out of an affiliated group to a corporate purchaser. Under this provision, a controlling parent of target may agree with the purchaser to treat the sale of target stock as if they'd sold their assets and liquidated into the controlling parent. So remember the liquidation of the control sub, you step into the basis of the liquidating company, and if you just had a let's pretend sale, didn't the basis of the assets go up to fair market value? You see, do you get that? So that if you have a target stock, it's treated like the purchaser, purchaser bought the stock. It's treated as if the target sold their assets. Again, they're very low basis, right? Most of them, so they're going to step up the fair market value. But now you use a parent subsidiary liquidation theory to step into the new high attributes, the new basis, which is high. Does that make sense? This one's never made sense to me before. This finally is making sense to me. You're using the parent subsidiary rules to do a liquidation where you step into the hands of the sub, but the sub just went through a transaction whereby through this election their assets stepped up to fair market value. And the cost of that, of course, is there wasn't a gain or loss. And if they had capital loss carry, if they had loss carryovers and stuff, then you could use that and cut the cost even more. So if you had that plus it's going into the parent subsidiary, and I think that's why this 338H10 election, that's one that's kind of popular. I think that's why. And up until now, I never really got the connection. Now I get it. Now I see it.
Couldn't you just do that with your subsidiary and then spin off into like a new subsidiary whenever you wanted? constantly reap the benefit of your loss carry forwards?
What are you saying, that a 338H10 election looks too good to be true?
No way.
It does, doesn't it? But I think it works, but you have to have that control, that 80%, you've got to meet that, and you've got to meet the parent subsidiary control requirements.
Right.
And they vary, but that's the idea. In other words, with the plain old 338A election, you have the cost, you end up with the higher basis. So, but this one you end up with a higher basis without any further cost to the sub. So I think it works out better. Let me just look at the 338A. Let's see. The 338A, the step up in basis comes with a great price, deemed sale of all assets, requires recognition of gain or loss of all the corporation's assets. 338H10, you sell the target stock is being sold out of an affiliated group to a corporate purchaser. The controlling parent agrees to treat the sale of stock as if they sold their assets in an affiliate. Okay, so they talk about the 338H10 under 13.2. Maybe we'll get a little bit of an idea on that. On page 233, purchases of controlling stock from a parent corporation for the section 338H10 election. We have a qualified purchase of stock from a corporation that owns at least 80% of the stock of target. A different election to treat the transaction as a purchase of assets versus stock can be made. Under this election, the parent seller and the buyer together agree to treat the transaction as an acquisition of assets versus stock. The selling parent corporation's basis in its target stock is ignored, and gain or loss is computed on all of target's assets as in a regular 338A election. Next page, in contrast to the regular 338A through G election, triggers a corporate level tax in addition to the shareholder level tax. The 338H10 election triggers a corporate level tax instead of a shareholder level tax. The underlying rationale, the corporate level asset gain recognized by the seller is an adequate predicate for the basis step up for the buyer, and the corporate level stock gain would ordinarily be avoided in any event. Okay, well that's deeper than I wanted to go, but I mean, there is a rationale for why the 338H10 works and 338A is not as good. I don't expect to ask you the rationale, but just the idea that they're better. If you don't understand that, look at the top of 234. We have an actual acquisition. The target parent sells the stock. We've got target and the assets and liabilities of an actual transaction versus 338H10, which is a deemed sale of assets instead of a sale of stock followed by a liquidation. It's just a deemed sale of assets by itself. Somehow they end up with just one transaction that might be taxable, not two. Okay, I don't get most of their pictures myself. If you do, good for you. Okay, so let's take a look at the questions, the true-false questions. Yeah, I did point out. Anybody else that, just pass them down.
Oh, okay.
Yeah, I did collect them if you came in a little bit late. I wasn't trying to penalize you for being late. I just forgot. Okay. Who's got a nice, strong voice? Lindsay, do you have your questions with you, or do you have to look at them? Okay. So read the first one.
After taxable acquisition, on all the assets of the business, all assets will always be held by the purchaser with a basis equal to fair market value of the asset.
Okay, is that a correct statement? Equal to? What would be a better statement? How about no greater than? No greater than? Because you might buy something and the allocation process would end up throwing a big number to goodwill. It's not equal to, because it could be less than fair market value if you didn't have enough. If your purchase price was less than the total fair market value of the assets, aren't you going to have a lesser number? That's what I was thinking. Let's see what they say here. The answer is false. It's true. An ordinary purchaser will have a cost fair market value basis, and the true purchase basis in each asset that's no higher than the fair market value. But there could be a shortfall, and they're bringing up liabilities. In a situation in which the acquisition of this includes the assumption of liabilities, these liabilities will not be reflected in basis unless they're fixed. If they're contingent liabilities, you're going to have to wait. There would be a shortfall in the amount treated as the price paid for the buyer. The shortfall won't reveal itself because the missing basis will be allocated to goodwill. I don't know if they answered that, but to me it's no higher than fair market value, maybe less would be the accurate answer. Lindsay, number 2.
The sale of stock will never affect the computation of the tax liability of the issuer corporation.
As professional takers of exams, never. I mean, that's only true a few times, right? You never recognize a loss in a 351 transaction. That's true, but most of the time it's false. But do you know why? Does anyone know why?
The exception to where you change in control and
Yeah, so that you may not be able to, if we have new people that control it more than 50%, then you may not be able to use all the carryovers. Remember that? That was the exception. So there's like 2 or 3 exceptions. Let's see. It's consistent with the general idea a corporation will be honored as a separate taxpayer, and that's true for C and S. However, corporations with the sale of stock will affect the calculation of income in a couple of situations. First, if the corporation has carryover losses that are limited under Section 382 and more than 50% of the stock is sold in 12 months. So if you hadn't acquired them, they've been able to use 100% of the carryover losses, and 382 may restrict that. So you don't get everything. And the second reason, if a corporate acquirer purchases the stock, that acquirer may elect to treat the transaction as an acquisition of assets under 338. Under that election, the target corporation will hold its assets at fair market value generally and will lose all of its tax history, E&P and NOLs and those sorts of things. Randy, read question number 3.
If an acquiring corporation pays cash to buy all of the stock of a target corporation and then liquidates the target corporation, the step transaction will apply and the transaction will be treated as a taxable acquisition of assets.
What do you think? Well, what it said was false. False. It says this is an accurate statement of the law in the Kimball Diamond case and the law of the old law. That's gone now. And under 338, no taxable acquisition of stock that will be recast as an acquisition of assets unless you make a 338 election.
So
You have to make,
So you have to make an election, right?
if you want that treatment, you have to make a 338 election. And we didn't get into the mechanics of 338, but there's a period of time within which you have to make the election. You know, I can't remember exactly what, you know, it's very, very specific. And once in a while, the IRS will extend that. Like if you got really bad advice, you know, from your legal person or your accountant or something like that, they misadvise you, they may give you an extension of time. But normally there's a limit on the time to make that election.
Aren't there some sections in the IRC where it's non-voluntary, you have to do it or something like that? But sometimes you can make an election, and sometimes you can't. You have to-
Yeah, I think there's something in 338, but I didn't dig into it where they made reference to a deemed 338 election somewhere in there. It could be, it could happen where you know, it's.
Oh, I was just talking in general, I was talking specifically.
Yeah, no, but specifically, I think there was one reference to it, but I didn't get into that. Okay, so, what number was that?
3.
3, okay, so, okay, Randy, 4,
If tax is the only determinant and the consideration to be used is cash, then in the case of an acquisition of a business owned by a corporation, the buyer will ordinarily prefer an acquisition of assets to an acquisition of stock.
okay, so generally, ordinarily, is that what a buyer would want? Yeah, okay. And they say it's true, most common circumstances, it's true. An acquisition of assets gives you an aggregate basis in the asset generally equal to the total consideration paid. Acquisition of stock gives you a basis in the stock. The acquisition of assets will usually be more valuable because you can recover the assets, you know, depreciation, cost recovery, if you will, a lot of stuff. You know, 7 years maybe. Stock basis usually can't be used until you sell it. You can't write it off, right? You know, so if you don't make an election for it, whatever. Then it says, next paragraph, note the availability of the election under 338 makes the actual form of the transaction less important because the buyer can elect to treat the transaction as a purchase of assets. In the event, though, the tax liability generated by the deemed sale will be the buyer's obligation and could be recouped against the seller of stock only if the purchase agreement provides. So smart agreements are going to provide for that, and not so smart agreements are not. Okay, I want to read number 5.
When a corporation sells its assets and then liquidates, the only significant income tax involved is computed at the shareholder level. The shareholders must recognize the difference between their basis in the stock holding and the amount they receive on liquidation.
Okay, we could answer this one before we did all this, couldn't we? Kind of, at least when we did corporate liquidation. Doesn't the corporation have a tax when they sell their assets or distribute them as a deemed sale? So the corporation has a liability potential, and the shareholders, what they got, what they received versus their basis. So that's false for that reason. There's tax on both ends. And number 6.
If a corporation sells its assets with a combined basis of $500 for a total consideration of $200, it will be able to claim a loss of $300 on its current year's tax return.
What do you think about that? No, don't you? It depends on what kind of a loss it is. Remember, corporations, if it's a capital loss, can't offset it against operating income, right? So they can get into that, but if it's a 1231 loss, you can offset it against operating income. So they said it's false. This is only true if all the relevant conditions apply, so the losses may be all taken currently. Because of the limitations on losses related to the character, especially capital assets, you can't take this aggregate approach, so you're not always going to get that. So they give it an example. If the corporation sold vacant land, basis of 400, fair market value of 50, so they have a 350 capital loss, and then they sell inventory, basis of 100, fair market value of 100, fair market value of 150, they'd have a capital loss of 350 and ordinary income of 50. So wouldn't they pay tax on the ordinary income of 50 and the capital losses, you're never going to get to use it? That's what they're getting.
So the language, it would be able to claim, because I guess that's the main emphasis.
Yeah.
That means that you're able to find a situation where it's against it and it still falls. Because like I read, it's like, okay,
Yeah.
the first thing, we can do it that way, so it's true.
Yeah, no, again, is there any time when you couldn't take the loss?
So
It's really, that's how it's asking, I know what you get. So that, if it's in my test, that's what I'm asking.
So it's just as strong as always.
Yeah, yes, it'd be wrong because a capital loss can't be written off. And, number 7.
When all the stock of a corporation is sold, the old earnings and profit account is wiped out.
Does the corporation still exist? So I think the earnings and profits is still there. Now, if you do a 338 election, you've changed all that, right? So, let's see what they say about it. It falls in general, the corporation retains its tax attributes when the stock is sold. There's exceptions in 382 and 383 are limited to carryover and built-in losses, other exceptions. So the earnings and profits is not going to change. This corporation still exists, it hasn't liquidated. If you do a deemed liquidation, you make a 338A or H10 election, then the earnings and profits is going to disappear. Okay? All right, so some of you came in late, so I'll tell you what I told the rest of the class about the test. I haven't made it up yet. I'm probably going to have a percentage of multiple choice questions, which may involve calculations or other things. And then I'm going to have short answer, problem, issue perception, calculation, combinations, those sorts of things. On this stuff, you know, if I went over something relatively lightly and I wasn't very precise on it, I don't expect to turn around and give you a real precise, you know, test on it. On the other hand, I want you to perceive issues, and we've talked about a lot of things, and we've seen a lot of things, so I'm going to probably try and give you some issue perception things just to see if you can spot those, which I think you'll be able to do. So that's it. So the exam is next week. I don't know how much time you'll have. We'll see. Certainly it'll be at least 2.5 hours. Okay. And remember, you bring your code. Bring your code and bring a simple calculator, not your Texas Instruments one with tax software.